Welcome, everyone. Thanks for tuning in tonight. We appreciate you guys taking time out of your busy days to kind of catch up with us here at the office. Looking to bring you some information here this evening. We got a couple special guests tuning in from Invesco. We've asked to be part of a conversation tonight, and just with all that's going on in the market and in the world and things with interest rates and Venezuela and every day and minute there's something new in the news. We just thought it'd be good to bring you guys some informational content to give you kind of a market outlook into 2026 and some of the things that our friends at Invesco may be looking at and seeing, and then also what impact we may anticipate if the Fed is in a position where they continue to ease with interest rates, and we just wanted to kind of pick their brains and get their perspective and share that with you. So I see a lot of you on the list today. A lot of you are here in Michigan, so you're going to be shoveling and dealing with cold weather with us, but I also see some folks on our invite list that are in warmer climates. So for those of you in Florida and Arizona and everywhere else, you can feel free to send some warm weather to our way here at Martin Associates. We'd appreciate it. With that, I'm going to introduce our friends here. We got James and Rachel are from Invesco, just to give you a little backdrop on who they are and why they're here. So James is an investment strategist at Invesco, responsible for helping develop and communicate the economic and financial market views of the firm's strategies insights team. Prior to joining Invesco, he began his career as a market strategist at Goldman Sachs, where he worked directly with private wealth advisors and their end clients, providing guidance on asset allocation, portfolio construction, and trends in the economy and markets. James is what we call a CFA, a chartered financial analyst. Charter holder, holds a Series 766 licenses and earned a Bachelor of Arts of Economics from the State of University of New York at Geneseo. Is that correct, James?
That's right.
Gotcha. And Rachel is Rachel Bonkowski. She's a senior market consultant for Invesco, serving advisors like us across the state of Michigan. She works directly with teams on portfolio management solutions, practice enhancement ideas, client education, which is a lot of what we're rolling out to you folks tonight. Originally from Louisiana, so down where it was warm, right? And then you moved up to this cold stuff. Just learned that Rachel's or now living in my hometown of Frankenmuth. So welcome to the cold climate here, Rachel. She's a finance graduate from Louisiana State University, been on the asset management team for 9 years, holds Series 766 certified exit planning designation. She and her husband, David, reside in Frankenmuth, where we were just chatting. That's where my daughter and son-in-law, my 3 grandkids are, along with her 2 dogs, Remy and Tucker. What kind of dogs, Rachel?
It's a Maltese and a Maltipoo. I get a lot of hate for it, but they're precious.
Gotcha. And how
Yep.
about you, James? Any dogs at your place or no dogs in the
No animals.
no animals? Gotcha.
No,
Life is
not yet.
simple.
That's
So,
Yeah.
right.
well,
In the
good.
city.
So I'm going to open this up to James and to Rachel, and then we are going to have questions, guys. So if you do want to send messages in we are kind of monitoring this, so Logan's going to be able to take questions. We're going to hold them off till the end. And then when we get done here, when we're done with the presentation, we'll go through and field any questions that came in. And Rachel and James have been kind enough, said they'll stick around and answer any questions. And if there's too many, you can email them into us and we'll follow up with you after the call. Okay.
Yep.
So with that, no further ado, I don't know who's going to go first here, Rachel or
Thank you,
James.
Greg. Yeah, I'm going to quickly just, I just want to mention, first of all, thank you to the team, Myron Associates team. This is huge. This is a great resource that not everybody gets from their financial advisors. And so it's extremely timely, very intentional. I was just speaking with Greg and the team before this. They plan to do these more and more. And at a time where a lot of clients are getting information, not only from the news, but from things like Chat GPT, that's a little worrisome just because it's not an end-all be-all resource. And a lot of times it can be wrong. So for example, and I wanted to take a screenshot of it, but unfortunately compliance would not allow me to show it. I actually asked a performance question on Chat GPT today, and it said, with it being the beginning of 2025, X, Y, and Z. And I was like, well, it's not 2025, it's 2026. And so one of the things that it said, I asked, why was it wrong? And it says, sometimes I will get an answer wrong if questions involve dates, holidays, or time-based reasoning. I anchor to the wrong year in the process. And so I just want to mention that this is a great place to get your resources and your information that you want. Invite your friends, invite your family as you get these invites in the future from the team. This is the better place to get the information. No, James is not Chat GPT, but he's really probably a better resource than that because I like to say he's really never wrong. Can't say that, right? We can't guarantee anything, but everything that he talks about today is hard research. It's hard numbers. It's not an opinion. It is hard-based research. So with that, James, I'm giving it to you. We're going to go the full 25 minutes, and we'll leave some time for questions.
All right. Well, thank you, Greg and Rachel, for the introduction, and good evening, everyone. It's great to be speaking to you all today, and Happy New Year, if it's not too late for me to say that. But either way, after a highly volatile 2025, I hope everybody's enjoying the very calm, very uneventful, you know, perfectly normal start to 2026 that we've all experienced. I'm kidding, of course, but in all seriousness, I am excited to have the next 25 minutes or so to talk to you all about our economic and financial market outlook for 2026. And I'll do this by walking through our portfolio playbook, which is basically a framework we use to assess how things in the economy and markets are evolving and what it could mean for portfolio positioning over the next 6 to 12 months. And the agenda for the playbook and for tonight's discussion more broadly is really just the questions that we ask ourselves and that we often get asked by investors, beginning with how did we get here, right? Before talking about today and where we're going, it's important to take a step back and think about where we've been. From there, I'll talk about where we are within the economic cycle, right? Is it early in the economic cycle? Is it the middle of the cycle? Is it, closer towards the end of the cycle? And what direction is the economy expected to move from here? After that, I'll talk about what the monetary policy response might be in 2026, or in other words, Greg alluded to it before, is the Fed going to keep lowering interest rates? Are they going to keep rates unchanged? Are they going to raise interest rates? And then finally, with the economic outlook and backdrop out of the way, I'll finish the conversation with a few key investment themes worth thinking about for 2026. So obviously, we won't be able to touch on everything in 25 minutes. And so please, as I'm going through the presentation, feel free to, I don't know, drop questions into the chat or save questions until the end because we will have time to answer audience Q&A. All right, so getting into it here. First things first, right? How did we get here? I think it's important to remember that heading into last year, right? Heading into 2025, the US economic outlook was strong in that the economy was expected to grow at an above average pace. Inflation was expected to fall to the Fed's 2% inflation target. The probability of recession was low. And at this time last year, the US stock market had just reached an all-time high. And so since then, right, over the past 12 months, it's really only been policy uncertainty that's disrupted that outlook. Because think about it, like 2025 last year started with a bang, Doge-related government tariffs in February, Doge-related government layoffs in February, tariffs on our three largest trading partners in the U.S. In Canada, Mexico, and China in March, and then Liberation Day tariffs on basically everyone, everywhere, all at once in April. And yet, since April of last year, think about what we've seen. We've seen tariff rates lowered as trade agreements were reached, right? The focus has shifted away from tariffs towards tax cuts with the one big beautiful bill. And the US central bank, right, the Federal Reserve, finally began to lower interest rates again in September of last year after keeping them unchanged the first 8 months of the year. And so as we've received greater policy clarity, right, the US stock market's largely begun to look past tariff-related uncertainty and now appears to be pricing in an optimistic economic environment for 2026. And the reason I say that is because since the US stock market bottomed last year on April 8th, it's subsequently climbed over 40%. It experienced one of its fastest recoveries on record in that it only took about 88 days to recover the nearly 20% drawdown seen the first few months of the year. Or in other words, all the money you lost in the first half of 2025, you made back by the 4th of July. And now the stock market as of today is back trading just around all-time highs, right? And so the broader economic story has gradually been changing the past few months from one of an impending economic slowdown to now a potential reacceleration as we get into 2026. Because heading further into this year, you have greater trade policy clarity from a stabilization of tariff rates. You have fiscal stimulus coming down the pike with tax cuts. You have monetary stimulus coming from rate cuts. ones we've received in the past, ones we're expected to receive in the future. And all those things together, stable tariffs, lower taxes, lower interest rates, should create a favorable environment for financial markets to do well and also for the economy to continue to keep growing, right? And so the stock market's pricing in optimism for 2026, and U.S. growth forecasts published by economists have also been revised steadily higher as well. And that's what we're showing on this slide, right? Growth expectations for the U.S. fell sharply after Liberation Day, but since the summer with the big beautiful bill, as trade negotiations were reached, as the Fed cut rates in November or September, November, and December, growth forecasts have been steadily revised upwards. And just, recent current events, especially geopolitical headlines, are unlikely to derail that economic optimism. It's definitely uncomfortable for people to see this type of thing, Venezuela, Iran, even Greenland come across the news headlines. But honestly, this is just market economic and political noise. And the reason I say that is because during past instances of geopolitical volatility, whether it's Cuban Missile Crisis, Yom Kippur World War, Soviet invasion of Afghanistan, or more recently, Persian Gulf War, September 11th, Israel Hamas, right? You name it. In general, over the next 12 months after these events start, right, the US stock market has historically been up about 15%. And during these periods when the stock market did fall, like 2022, 2001, it wasn't necessarily due to the geopolitical event itself. It was mainly due to the economic background in which like the geopolitical event took place. So September 11th didn't cause the market to fall 20%. The market was already declining in 2001 due to a recession and due to the bursting of the dot-com bubble. 2022, right? Russia's invasion of Ukraine didn't cause the market to fall 6% over the next 12 months. That was primarily due to a slowing economy as a consequence of the Fed raising interest rates in 2022. And I'll show that later on. And so, our suggestion would be that even though these types of things, geopolitical events, tend to make people uncomfortable, they shouldn't necessarily change the way you invest as far as your portfolio is concerned. Instead, arguably, the bigger risk investors have to deal with all the time is whether or not we're going to have a recession. And historically, there have been a few market and economic indicators that we can look at that have signaled a recession in the past, and we're laying those indicators out here. And so how this works, how recessions normally come about is that over time you tend to see a buildup of debt, right, in the economy. That increase in debt results in higher inflation. Higher inflation causes the Fed to have to raise interest rates, right? So think about 2022. Higher interest rates cause a lot of volatility in the fixed income market. And then finally, commercial bankers begin to tighten lending standards to reduce the risk that they won't be repaid on loans if the economy slows. And so these are check boxes. And we currently don't have any of these things checked off. Why? Because we're not currently seeing any of these things taking place within the economy. And so, for the sake of time, we won't go through each of these indicators in great detail. It's also probably the most boring part of the presentation, so I'm going to make things brief. And so just focusing on debt, um, specifically, this is a common question, right? Is the US drowning in debt, right? Are corporations too heavily indebted? Are US households taking on too much debt? And the answer right now is no, right? And the reason we say that is because during past, heading into prior economic recessions, which are indicated by these shaded bars here on these charts, the interest expense of US corporations had historically been high or rising, right? You can see that here. You can see that in the late 80s, early 2000s, 2008, even 2020, right? Interest payments from corporations had been trending higher. Right now, interest expense in US corporations is the lowest it's been in 25 years. And that's despite the highest interest rates we've had in 25 years, right? And so it's just not true that U.S. corporations are drowning in debt. And then on the household side, it is true that credit card delinquencies have been rising the past few years. You do see headlines about this pretty frequently. But we would argue that that increase in delinquency rates has primarily been a function of 25% cumulative inflation over the past 3, 4 years, as well as a significant climb in interest rates over the same period. But importantly, we can see that in recent economic data, credit card delinquency rates have been trending lower. Why? It's because inflation has been moving lower over the past 2 years or so. And along with that, interest rates have been moving lower too, because lower inflation allows the Fed to cut, which is exactly why the Federal Reserve has been lowering interest rates since 2024. Right. And so as inflation slows further from here, as we expect, and as the Fed continues to cut, we expect credit card delinquency rates to trend lower as well and offer some relief to US households. And so, I'm going to talk about why we expect the Fed to continue to cut interest rates in a minute. But what we're just showing on the right side of this slide here is the short-term interest rate controlled by the Fed. And you can see that in the lead up to the past two recessions, the Fed had aggressively raised interest rates, right? You saw that in the early 2000s. You saw that in the late 2010s. This time around, what's interesting is even though the Fed raised rates, no recessions. Why? Because households and corporations weren't indebted. And so as inflation has trended lower, the Fed has been able to cut interest rates. And you usually don't see economic cycles in bull markets end when the Fed is cutting, right? You usually see them end when the Fed is raising rates. And so it's a good sign that the Fed is continuing to cut interest rates from here, and it doesn't suggest that we're about to have an imminent recession. And then lastly, as far as lending standards are concerned, the most recent data shows us that only 6% of bankers have reported cutting back on new loans, whereas before past recessions, that number had historically been around 40%. So commercial bankers aren't telling us that they're afraid of an impending recession. And so taken together, right, the normal signs of a recession just don't exist in the current economy. Businesses and US businesses and households aren't excessively over indebted. The Fed is cutting rates. Commercial bankers are still lending people money. All of that is a good sign, and all of that suggests that the current economic cycle that we've been in since 2020 may have room to run from here. And so what we're showing on this slide is just the cumulative length of past economic expansions, or in other words, periods when the US economy was growing that weren't interrupted by a recession. And so these business cycles normally last around 8 to 10 years. The current cycle is only about 5.5 years old. And since, like I said before, this year you have stable tariff rates, tax cuts coming, and lower interest rates, all those things together suggest that the economy should continue to grow throughout the next 12 months. Now, importantly, though, that's not to say that, economic benefits will be evenly distributed around the country. And so one topic that's become popular recently is this idea of a K-shaped economy, right? Where asset owners and high income households do well, right? Representing the upward leg of the K, whereas lower to middle income households continue to feel pressured, right? The downward leg of the K. And so one, nice part about my job is I get to travel all around the country talking to clients in every part of the US. And one of the most common questions I receive is why is the market doing so well when I'm feeling so poorly, right? You're seeing this huge disconnect between how the economy is doing versus how people are feeling. And it's not just, you don't just hear it. It's not just anecdotal evidence. You can see it in actual economic data as well. And so quickly, what we're showing on this slide, dark blue line, left axis here, US stock market, all-time highs. At the same time, light blue line, right axis, consumer sentiment is close to all-time lows. And the two usually track each other closely, right? When the stock market's doing well, people tend to feel good. That hasn't been the case the past few years. Or look at the right, the chart on the right, US stock market, again, all-time highs. Job openings have declined to multi-year lows. And so the takeaway of all this, right, the important thing to remember is just that the stock market is not the economy, right? Most businesses and most people are employed by mom and pop shops on Main Street, not by large multinational corporations. And so the question really from here is, over the next 12 months, then, does the stock market catch down to match the economy? Or does the economy catch up and reaccelerate to match the stock market? We think the latter, right? We think the economy, like the real economy, right, Main Street, accelerates from here and catches up to the stock market or Wall Street. And a big reason for that is continued rate cuts by the Federal Reserve, along with tax cuts and stable tariff rates, like I discussed. But transitioning to monetary policy quickly so that we can get into a discussion on, market implications. There's a few reasons why we expect the Fed will continue to cut interest rates from here. The first is that although tariffs are expected to result in a temporary uptick in inflation, the uptick in inflation is really only expected to be modest, and then it's expected to fade quickly over the next few months. And so the chart on the left shows the rate of inflation the past few years. You can see that, 2021, 2022, some of 2023, inflation was very high. We do expect inflation to tick up a little bit from here, but nowhere near the levels that we saw 3, 4 years ago. And then importantly, 6 months from now, we expect inflation to begin to trend lower again till it gets to about 2%, right here. And the bond market largely agrees with us. And so what we're showing on the right is the bond market's expectation for inflation. And usually you want this figure to be between 2 and 3%, right? 2022, that was a problem. That's what caused the Fed to have to raise rates. But right now, the bond market's telling us that inflation not expected to be a long-term issue. So that's giving the Fed room to cut rates. And then the third and final, probably most important reason we expect the Fed will continue to cut rates is because the past few months, well, the past few years really, we've seen a noticeable slowdown within the US labor market, right? Job creation has slowed from 350,000 jobs being added per month in 2022 to now only about 70,000 jobs being added per month. And at the same time, job openings, hiring rates, job quits rates, they've all decelerated or decreased to multi-year lows, right? So businesses aren't really hiring, but importantly, they're not really firing either. Everything's just sort of slowed. But people can feel that, especially if you don't have a job or you're a recent college graduate looking for a job. It feels like you've sort of been boxed out. And so the primary way that monetary policy can help is by lowering interest rates, right? Because that helps boost US economic growth. The stronger the economy is, the more jobs that are generally created. And so a big reason why we expect the economy to accelerate from here is lower interest rates along with tax cuts, which we're going to see over the next few months. And so what does all that mean as far as markets are concerned? And so we have about 10 minutes left before we can move on to question. How I want to end is just by highlighting a few key investment themes we're thinking about for the year ahead. And so we're laying those investment themes out here. The first is that we expect the dollar to weaken further, and that should provide a tailwind to non-US assets, so non-US stocks, non-US bonds. The second theme I want to highlight is that when the Fed cuts rates and the economy avoids a recession, which is their base case, that's historically been good for US stocks in general, right? The third theme is that as the economy accelerates from here and as inflation stays high, but then eventually begins to cool, that dynamic should be supportive of broader market participation. And what I mean by that is the past few years, the part of the market that has performed best is pretty much just US tech stocks, right? We think that's going to begin to change because of because of the economic setup we have at the start of 2026. And I'll get into that in greater detail in a minute. And then lastly, we think it's very important that investors begin to diversify portfolios and reduce AI-related tech stock concentration risk. Because although that part of the market has done extremely well the past few years, again, given the setup we have at the start of 2026, we think other parts of the market are going to begin to outperform. And so you want to make sure you're diversified across world regions, right? Across market cap size, right? Large companies, middle-sized companies, small cap companies, and across different sectors, right? The tech sector is not the only game in town. I mean, last year, industrials, financials, materials, they all performed really well. And those are the parts of the market that investors usually have, you know, a small weight to within their portfolios because the past few years it's just been all tech. Anyway, so let's get into these themes in greater detail, just sort of going through each one by one real quick. One thing we expect to continue is the weakening of the dollar. And so last year we saw the dollar weaken by about 10%. It was one of the worst years the past 50 years for the dollar in terms of performance. And yet, despite that weakness, the dollar still remains overvalued compared to its own history. And the thing that 2025 had in common with 2007, 2006, 17, 2002, 2003 is all these other years that were accompanied by dollar weakness, right? You tended to see non-US assets perform really well, right? I mentioned earlier, S&P 500 is back trading at all-time highs. It was up about 18% last year. But everywhere you look around the world, markets are also trading at all-time highs. Like French, British, German stocks, all-time highs, Japanese, Korean stocks, all-time highs. And all of those world regions outperformed the US last year. And a big reason for that was the weakening of the dollar. And so periods when the dollar weakens, right, which we're showing here with these dark blue bars, have historically been accompanied by very strong performance of emerging market stocks, right? Developed market stocks, commodities tend to do very well, specifically gold when the dollar weakens, and so do non-US bonds, right? Now, US bonds, US stocks, they tend to do fine regardless of whether the dollar is strengthening, right? Light blue bars, or when the dollar is weakening, dark blue bars. But if we expect the dollar to continue to weaken from here, you want to make sure you have exposure to non-US assets within your portfolio, right? Which a lot of clients seem to have, a lot of clients seem to be underweight, or in other words, tend to have very little invested in non-US markets. We think that one area that could be poised to outperform this year is non-US markets. So it's sort of a theme continuing from 2025. Second theme is right when the Fed cuts rates and the economy avoids a recession, that tends to be good for stocks, right? And that scenario is illustrated here by the dark blue line, right? When the Fed cuts rates and the economy avoids a recession, over the next year and a half, S&P 500 US stock market has historically been up about 32%. Now, when the Fed cuts rates and the economy enters a recession, in that case, stock market tends to fall. But we don't think we're going to see this pink line this year. We think we're going to continue on seeing this dark blue line here, right? The Fed started easing or cutting rates in September 2024. And since that period, the market's up about 30%, right? They continued to cut rates in September of this year. What does that mean? Over the next 18 months, we think we could see another rally of 30+%. And so Fed easing, no recession, tends to be good for stocks. Importantly, during situations like I described before, right, where the economy accelerates while inflation remains somewhat high but begins to trend lower, that tends to be good for cyclicals, or in other words, financials, industrials, materials, rather than just tech. And so to prove that point, what we're showing here is the correlation of different parts of the US stock market to economic growth on the y-axis, right, moving from top to bottom, and versus the correlation of these different parts of the market to inflation on the x-axis, moving from left to right. Right? During periods when the economy is growing and inflation's still high, you want to be invested in this top right quadrant, right? So what do you want to be invested in? Large value stocks, mid-sized value stocks, small value stocks. So what's the common denominator, right? The common denominator is value, right? Rather than growth stocks. So growth stocks are like tech, healthcare, those sorts of sectors. Value is right, financials, industrials, utilities, um, and materials, right? You want to have more exposure to more value-oriented parts of the market, not just growth. So growth has done very well, right? Tech has done very well the past few years. But the problem with that at this point in time is as those parts of the market have done really well, they've accounted for a growing share of stock market indices, right? Not just in the US, but around the world. And that's what we're showing here, right? Basically, since the launch of ChatGPT in 2022 and the start of this AI craze, these AI stocks have accounted for, right, 19% of the US stock market in 2023, 25% in 2024, 28% in 2025. And so that creates issues because now portfolios in a lot of cases are very concentrated, right? And so just five stocks alone, right? NVIDIA, Apple, Microsoft, Alphabet, Amazon account for 30% of the S&P 500. So within an index made up of 500 companies, five of them account for 30% of it, right? And so the S&P 500 at this point is basically just concentration disguised as diversification. And that's a problem because that means the risk and reward characteristics of that large index are really just being driven by a few high octane tech stocks, right? Everybody knows the name, uses their products, but the problem is portfolios are supposed to be diversified, not concentrated. And so one strategy from here is, and what we've historically seen in the past is following periods of very concentrated markets, right? An equal weighted investment approach has tended to outperform, right? And so looking at the chart on the right, we can see that historically, when a few stocks have made up a very large portion of the market cap weighted S&P 500 index, over the next 5 years, an equal weighted S&P 500 index has historically outperformed. And by equal weight, I mean each company with the index gets the same exact weight to prevent a buildup of concentration. And so the more concentrated markets are today, the better equal weight strategies have tended to perform over the next 5 years. And so just to recap the themes, right? A weaker dollar, that should be good for non-US stocks, non-US bonds. Fed easing without a recession should be good for US stocks in general. But we want to make sure we're diversified across sectors, right? Across style, value, and growth, across market cap size, large companies, middle-sized companies, small companies. And it's very important that we try to reduce AI concentration risk. Now, I think these companies are still going to continue to perform really well, right? I do not believe we're in an AI bubble. But just in terms of risk management, and also based on the chart on the right, in terms of trying to maximize future performance, diversification, right? Diversification is the name of the game. Whereas, 2023, 2024 concentration performed well. We think now is a good time, especially at the start of the year, to begin to get diversified. So I'm looking at the clock, 26 minutes. I guess I'm a minute over, but I'll stop there for now. And happy to open up the floor to any questions. Thank you very much, everybody, for your time.
I
Well,
just see a question from Gary. Yes, we can send these, our client approved, so we can get these to the team, and Greg, you guys can get them, or Logan, you guys can get them sent out.
Logan, you want to go through some of the questions? Any questions for James as of yet? I guess we're going to hold off to the end, but if there's a couple there now that we can field towards James.
Yeah. Yep. And yeah, James, you kind of touched on it at the very end there about you said AI bubble. So I'm sure you probably got that question quite a bit, but what do you think about AI stocks and becoming an AI bubble, and talks of that, and maybe comparing that to like the tech bubble and some differences between what we're seeing today versus then, and what makes you say, hey, we're not in an AI tech bubble today. And then kind of going off of that, you also mentioned market being at an all-time high. Everybody seems to get a little bit squirrely whenever we're setting all-time highs. But what do you think about the market being at all-time highs today? You mentioned you think we're set for some more expansion to take place throughout this year and maybe the next couple of years here. But how AI kind of can play into that with the expansion theme, and are we in an AI bubble today?
Sure. So tackling the AI bubble question first, there's a lot of differences between today and the bursting of the dot-com bubble in 2000. The biggest difference is, large tech companies today actually make money, whereas in 2000 they did not. And so everybody buys products from Apple, Microsoft, Alphabet, and Amazon, whereas in the lead up to the dot-com bubble in the late 90s, early 2000s, a lot of the stocks that performed best didn't make any money at all, and they were just rallying on speculation alone. And so, like Nvidia stock, I'll pick on them for a minute. That stock's up over 1,000% the past few years, and everybody freaks out about that. But the reason the stock is up 1,000% over the past few years is because earnings growth has been over 1,000% over the same period. We're talking about a company that made $3 billion in profit in 2023, and then $30 billion in profit in 2024, right? In 2025, they're expected to make $60 billion in profit. That's real, tangible earnings growth that you just did not see in the late 90s and early 2000s. And because that earnings growth has been so strong, it justifies the very strong market performance, and it actually keeps stock valuations way more reasonable than what we saw in the early 2000s, for example. For any client who really wants to get into this, I actually made a piece, sort of a deep dive into the AI bubble, which Rachel should be able to share with you too, if if you guys think that would be helpful. And so, no, we don't think there's a lot of differences between today and the 2000s. We don't think we're in an AI bubble. The biggest issue, though, with what we've seen in markets recently is this buildup in market concentration, right? It's right. Markets haven't historically been concentrated forever, which is exactly what we're trying to show on this slide here, right? Today's winners aren't necessarily tomorrow's, right? Not because they necessarily perform poorly going forward, but because new companies come onto the scene and compete and perform really well, and therefore have a larger weight within these indices, sometimes at the expense of the primary of the original dominant companies. And so it's just extremely important to to diversify. Um, just in terms of risk management. And since timing the market's impossible, right? It's always good to make sure portfolios are diversified at all times rather than trying to predict when these companies may begin to underperform compared to the rest of the market. Now, the second question, I rambled on too long. I forgot it. What is it? It's AI bubble, and are you gonna have to
Yep.
repeat it?
That's okay. Yeah, markets being at an
Oh yeah,
all-time
all-time
high
highs.
today.
I got you. I got you. Okay. So early on in the presentation, I talked about this time last year, market was at an all-time high. How's it done since then? It's up about 20%, right? New all-time, like all-time highs are usually followed by new all-time highs. You want evidence of that? Just look at a long-term, look at a chart of the long-term performance of the S&P 500. It just moves from the bottom left to the top right, basically in a straight line. Now, it's difficult to experience all these bumps along the way, but as the economy has continued to grow over time, that's meant US corporations continue to make more money, and as corporations make more money, that's reflected in a rally in stock prices, right? And so investing at all-time highs hasn't historically negatively impacted performance. In fact, investing at all-time highs has historically been the best time to invest because new all-time highs are followed by new all-time highs, right? And so again, you can't time the market, but the fact that markets are at all-time highs doesn't necessarily have any impact on future performance. Ultimately, the biggest risk to the economy is whether or not we're going to have a recession, and a recession doesn't appear on the horizon anytime soon. And so, when you have tax cuts and rate cuts and stable tariff rates, that's a good mix. That's a good mix for stocks, at least over the next 12 months. And so, the fact that markets everywhere at all-time highs right now shouldn't have it shouldn't have a negative impact on investor portfolios. The key risk is always and at all times whether or not we're going to have a recession, and a recession just does not appear likely anytime soon.
Got it. Makes sense. Next question here is kind of a geopolitical question about events impacting the stock market. So with current news headlines about ICE, Greenland, affordability impacting markets, or not impacting markets, but in affordability today, kind of with that K-shape that you're talking about. How do you expect those items to kind of play into markets, and what have you guys been seeing or been hearing on questions around that?
Yeah, so it doesn't. I've gotten this question a lot, and it's not really a market problem, but it does become a political issue. And obviously, this year is an election year, right? The midterms are coming up. And so, even though geopolitical headlines and income inequality and really weak consumer sentiment, although they haven't historically impacted the stock market, they do tend to impact the results of different elections, right? Because people voice their frustration through the polls. And so right now, Republicans obviously control all three chambers of government, right? White House, House of Representatives, and the Senate. Our expectation and just like the baseline expectation in general, I think like the consensus is that uh, Democrats will take back control of the House of Representatives. Obviously, it's not a presidential election year, so Republicans will maintain control of the White House, and then the Senate will probably stay Republican. So the takeaway is the past 2 years you've had unified Republican government. Beginning next year, you'll probably have divided government, right? Split Congress. And so what does that mean? As far as markets are concerned, doesn't mean much. But it does mean that if Democrats are expected to take back control of the House, then it gives President Trump one more year of unified government to try to get through as much of his agenda as possible, right? So like last year, you start with the most unpopular stuff first, right? Start with a bang, start with tariffs, and then move on to tax cuts. This year, you've seen all this Greenland stuff. You're seeing Venezuela because he wants to do that as far away from November as possible. But what that means is, right, if we expect divided government going forward, there could be a lot of headline volatility between now and November. I mean, you've already seen it the past 3 weeks, right? Because if you only have one more year to get through your agenda with a unified government, right, you got to move fast. President Trump usually moves pretty fast anyways, hard to keep up with. And so as far as the economy and stock market's concerned, it doesn't it doesn't have a profound impact, but it definitely has an impact on on us as investors because of all the headlines, which can sometimes make us uncomfortable or angsty or whatever. Um, but the important thing is, as far as your portfolio is concerned, don't let those headlines and those feelings change your long-term investment plan because ultimately the things that are going on doesn't really impact corporate profitability or the economy at large, right? It shouldn't derail your investment plan. So like anticipating volatility and being comfortable with it is more important than feeling like you have to always respond to it, right? So that's the sort of long-winded answer there, right? Expect a lot more of this the next few months, but it's okay. It's gonna be okay long term.
Got it. Thank you. Like maybe a last question here. You mentioned about the U.S. dollar falling. If you could answer kind of briefly, what factors you think are gonna? I think you said it's still overvalued. So are there factors playing into causing that dollar to continue to devalue, or do you think it's just more kind of reversion to the mean that you think there's room for it to fall, for one? And then two, assuming we continue to see that trend play out, what does that mean for U.S. stocks, if anything? I know you mentioned could be bullish for internationals, but specifically just U.S. based and the dollar devaluing, does that impact U.S. stocks as well?
Um, yeah, so I'll try to keep this quick. Dollar is probably my favorite topic to talk about. And so just to sort of provide a framework about what drives exchange rates are extremely complicated and difficult to predict. But in general, you can think of exchange rates as being influenced by like growth rate differentials, which basically means, the rate of US economic growth compared to the rate of economic growth in different parts of the world, right? So growth rate differentials, interest rate differentials, right? US interest rates compared to interest rates in other parts of the world. That's number two. And then number three is capital flows. So where are people investing money, right? Is money flowing into the US or is it flowing out of the US into non-US countries, right? That's the third one. So the reason we expect the dollar to weaken from here, along with reversion to the mean, like you mentioned, is because the Fed is expected to cut rates more than other central banks around the world, right? The European Central Bank, they're done. They already finished cutting rates. Bank of Japan is actually raising interest rates, and although the Bank of England is expected to lower rates too, they're not expected to lower rates as much as in the US, right? And so money is expected and always flows to the place where it can earn the highest risk-free rate of the return, which is no longer necessarily in the US because of the direction of interest rates around the world, right? US growth, tariffs ultimately are a drag on the US economy more than non-US economies, right? And so even though the US economy is expected to do really well in the coming year, right? Non-US countries are expected to see a pickup in economic growth along with US economic growth, right? And they're expected to achieve higher rates of economic growth than they have in the past few years, right? So you're seeing a narrowing of interest rate differentials, you're seeing a narrowing of growth rate differentials, and because non-US assets have performed so well the past 12 months, and because we expect that trend to continue, maybe investors are going to invest their next best dollar into non-US assets rather than US assets. So that's capital flow, right? Going into non-US assets. So of the all three of the explanations I gave for exchange rates are pointing in the direction of further dollar depreciation. What does that mean, right? Really simply, I already touched on it earlier, right? When the dollar weakens, non-US assets tend to perform well, US assets do too. It's just that non-US assets tend to outperform in periods when the dollar weakens. So it doesn't really it's not going to impact US stocks and bonds necessarily. It just means that you want to have greater exposure to non-US assets within your portfolio, right? And in general, I used to work in wealth management. Like I used to do a lot of portfolio reviews. A lot of clients don't have much exposure to non-US assets at all. Now, I'm not saying they should be 100% of your portfolio, but I'm saying if you have a 0% weight to non-US assets, maybe you want to increase it. And a non-US, a weakening of the dollar should be a good catalyst for further non-US asset performance from here.
Gotcha. Perfect. All right. Well, that looks like it's all the questions, and I kind of ran over here, so I think we're probably good to get things wrapped up, unless you have anything you want to add on here at the end, Greg.
No, I mean, thanks, James. That was awesome. I think a lot of the things that you touched on and mentioned, for all of us as investors, right? The news is nonstop, moving by the minute, by the second. The challenge for all of us is keeping our emotions in check, right? So we turn on the news and we got talking heads coming from every which way. And, a year ago when the tariffs were announced, right, a lot of the top quote unquote economists had suggested markets were going to, kind of tank. And yet a lot of these quote unquote top economists for wrong markets continue to prevail. If we go back to when COVID hit, we saw a significant correction there where the S&P dropped, close to 30% over 60 days when the whole world was shut down. And, if you stay the course, markets recovered, and then also the index finished up. So, back to your point, being able to time markets, we always say and our clients get tired of hearing us saying, time in the markets over, timing. It's just getting the timing correct. And we've had lots of volatility, and that's where our job is on the advisors front, to make sure we keep our clients prepared for down markets before they happen, so they're not reacting to them, when they do. And, down markets, do create opportunities. It's just can be unnerving on selling with all the news, and it's coming at us 24/7. We're getting stock news on the Disney Channel, the CNN, Fox News. It's everywhere. So for folks to try to digest all of that as quickly as it's coming in, it's, your presentation's, helpful.
Well,
So I
thank you.
appreciate that. Anything else on your end, Rachel?
No, we are good to go.
All right. Yeah, so with that, guys, we will wrap up. We thank you immensely for joining us, Rachel and James, tonight. We appreciate your time and expertise. James and Rachel are a small part of what we got behind our whole team here at the office, to continuing to do our due diligence, behind the scenes, and putting together portfolios and doing the research, and continuing to stay on top of these things. And as Rachel mentioned, we're going to look to continue to provide content like this going forward as well. So any feedback we can receive from any of the folks on the call tonight, feel free to email myself or Logan or Brett or Adam or Wayne or Mike or Joe. We're all here to support you guys with anything and everything that you need, and we'd love to hear your feedback as to what you're looking for. If this has been helpful, future content, we want to continue to keep news in front of you and to stay on top of things for you. So with that, again, if you have any additional questions, feel free to email them in to any of us here at the office, and we will respond to you and get that back to you. And I think we have this recorded as well, and the slides are approved. So anyone that may want copies of those, we can certainly send those out as well. So with that, we will let everybody get to what they need to do. I know when I get home, I have to go plow my driveway. My two neighbors, for those of you that are in Florida and Arizona and all the warm climates, just enjoy your warm weather and think of us up here in the cold Michigan. So. All right, guys, thank you very much. Have a good night. We'll talk to you again here soon.
Thanks.
Thanks, Rachel. Yep, bye-bye.
Everybody.